Welcome back everyone to the Audacious Witch channel where we talk about the magic behind the stock market. Amazon's latest announcement isn't just a warning. As you're about to see, it's a countdown to something unimaginable. Stay tuned. On this episode, don't say we didn't warn you, as Amazon has just issued a dire warning that signals the unthinkable is about to unfold. What about the trade desk stock as this frightening situation unfolds? So after 8 hours of research, you wouldn't believe what I found out. But this isn't just going to impact big tech companies. As you're about to see, it's also going to impact every North America household. Stay tuned till the end of the show to learn how you can join the winning side and maximize your returns to the highest level without any stress. This isn't just about big tech, it's about the US consumer. And as you're about to find out, their confidence is crashing. And for the market and for a lot of companies, that's the worst possible sign. As Amazon issues disappointing revenue forecast, it's about to get much worse and points to the weakest growth on record. This is a problem because when the big companies like Amazon are saying that revenue is going to be a problem, it all points back to the same thing. That's the US consumer, and that's the labor market. We're going to talk a lot about it in a bit, but let's take a look at what Amazon's warning about. Because they expect sales this quarter to be between 151 and 155 billion, far less than 158 billion analysts were expecting. Now keep in mind, we said that analysts were going to set the bar high. And why did they do it? Because they've been selling stocks to retail investors who have been buying big. This is sending Amazon stock down last week and pulling the rest of the market with it, but that's not the warning. This guidance anticipates an unusually large unfavorable impact from foreign exchange rates. The impact amounts to 2.1 billion or 1.5%. What they're talking about is the dollar, and we've noted that the dollar has been on a tear. It's been very elevated. It's pointing higher again. Many expect the dollar to keep moving in an upward pace. Now, if we talk about the impact of companies, it's showing up in earnings now in a dramatic fashion. In this earnings season, we are seeing a lot of hate on consumer sectors, especially retail companies like Elf, Estee Lauder, Honest, Fubo. They're all down approximately 20% following their latest Q4 earnings. Companies like Nvidia, AMD, Coinbase, PayPal, and Tesla, the hottest retail tech stocks, were down 5 to 10%. Even though most of them are still making huge profits, why is Wall Street, the big boys, panicking? Why are they selling stocks like AMD while the valuation is cheap as ever? I mean, forward PE of 19 with a 24% revenue growth rate. Why? Stay tuned. Anyways, back to the mighty dollar. It's going to have a massive negative impact on the labor market. Let's take a look at what this means for sales as we look at the US dollar index in red against inflation adjusted, or what's called real retail sales, that's in blue on a year-over-year rate of change. The start at 2011, we see the dollar start to move higher, and it has an immediate impact on real retail sales. You can see a deceleration then takes hold before the dollar starts to cool off its trend. But let's move forward to late 2014. As we turn into 2015, what happens? The dollar goes on a massive tear, and real retail sales heads down. Once again, we see the same effects in around 2018. And look at what's happening around 2022. The rising dollar finally had an impact on the US economy in the form of real retail sales that have been largely negative for the past 3 years. Right now, even though the dollar's pulled back a little bit, the expectations are it's going to head higher. you can start to get some perspective here of why analysts are setting the bar so high for American companies. Because the rising dollar is going to have an impact not just on their bottom line, but going forward, we're going to see it have a huge impact on exports and the labor market. The US dollar index, which measures the greenback against the basket of rivals, has its highest level in more than 2 years. The dollar climbed steadily from late November through mid-January. It has fallen a little bit since then. But the problem here that Amazon's saying, look, this is going to get worse. This is going to have a bigger impact going forward. Because right now there's absolutely no signs that the dollar is going to weaken because of the trade war tariffs, and that will affect the import of a lot of goods. Which made me realize that the Trade Desk CEO, Jeff Green, said for the first time in 33 quarters as a public company, they fell short of their own expectations. For the first time in 8 years, they missed the expectations they set. And it was their fault. He owned the mistake, but I think it's much deeper than that. It's about the consumers are getting weaker. The TTD stock is now down nearly 50% off its recent highs. How bad were Q4 earnings? It's not that Q4 was abysmal. However, guidance for Q1 2025 is for just 17% growth, a major backward step. It's not their own misstep. Great CEO like Jeff Green of successful companies likes to take responsibility for everything, even though it's not their fault. Some companies like to blame macro situation, but not the trade desk, which is why I will be a buyer of TTD stock when it reaches bottom. When is the bottom? Stay tuned. Amazon CEO Andy Jassy has been on a cost campaign since late 2022. The company laid off more than 27,000 corporate employees that year, and across 2023, job cuts have continued last year and are now stretching into this year. It's not just Amazon cutting jobs. Google told staffers in its people operations and cloud organizations this week that it plans to cut employees as part of internal organizations too. After Google reported revenue that missed expectations for the fourth quarter, which tanked the stock by 8%, Apple also double missed revenue and earnings expectation, just like Tesla. What does that tell you? Based on what we're seeing from the dollar, how it's crippling earnings and going to hit profits. It means companies are going to have to cut even more employees, which means more consumers are out of a job. So you see the labor market slowing down. What does that mean? Consumers don't want to borrow, and of course, banks don't want to lend because they're not sure they're going to get their money back. And businesses, we already know they don't need to expand because demand continues to fall. Look at those weak guidance. Now, we did see initial claims jump by 22,000. That's on a seasonally adjusted basis. But you'll note that continued claims only fell by 5,000 on seasonally adjusted basis, 20,000 on a non-seasonally adjusted basis. But the issue here is continued claims on non-seasonally adjusted basis remain at 2.1 million. 2 million was the inflection point. Once we got there, things would eventually spiral out of control. What we are now seeing, initial claims following, continued claims higher. Let's go back into the data from late 1980s. And what do we see? Continued claims in blue and initial claims in red follows. And you see this relationship as continued claims go higher. Initial claims follow each and every time because those people that are on unemployment for extended periods of time, what you find out is their loss of spending into the economy affects other people's jobs and other people's incomes. It was only a matter of time now before we started to see initial claims rise, and with, of course, the federal government cutting spending. We could see that number go up even more. That will bring the US into a recession. The dollar is soaring higher now as Trump affirms the March tariffs for Canada and Mexico that many thought weren't going to happen. Dollar spot index DXY jumped 0.5%, the largest jump in 3 weeks after Trump cited a March 4th implementation date on a post. So think about this from the consumer perspective. They're already under stress. They're already seeing the delinquency rate rise because they don't have enough money to pay their bills. And now what's going to happen? Prices are likely to go higher because more tariffs could be the nail in the coffin for Canada. According to RBC Economics, 25% tariff on all steel and aluminum imports could reduce the Canadian GDP by between 3.4% to 4.2%, which could put Canada straight into a recession and cause unemployment rates to increase by 3% to 9.6%, which will cause the biggest stock market crash we never seen before. This will have the worst effect on US economy because the counter 25% tariff will be put on the US by Canada will cause a stagflation in the US because inflation in the US is at 3%. That is so much higher than in Canada at 1.9%. So how I will win big on this huge opportunity that is made very clear by both Wall Street and the president? If you keep buying the dip when it keeps dipping, you will lose your shit. Your dry powders will be out before the market really crashes. I will sit on a pile of T-bills with dividend monthly and wait until the market crashes while I study the companies I want to own for the long term. Once the bottom hits, I will be buying audaciously. I've been bullish about the trade desk after I first introduced it to you when it was close to 80. I bought my first dip. I don't even think about the position because I will love it even more at 69 or 60, 50, and 40. The lower it goes, the more attractive the share represents. Because when you are the buyer, you wait till the best offer and then you take it.